Here's what really sets interest rates, not central banks.
I'm Bob Stokes with Elliott Wave International.
Most everyone is familiar with the phrase, keep your eye on the ball, which of course means focus on what really matters. Those who seek clues about the direction of interest rates believe the ball is their nation's central bank. For example, in the U.S., Federal Reserve announcements are the subject of countless financial headlines, like this one from September 22nd. Fed signals bond buying taper coming soon. Rate hike next year. The assumption in most of these headlines is that the central bank determines the direction of rates. However, if interest rate observers kept their eye on what really matters, they'd be watching the bond market instead of the central bank. In other words, markets lead and central banks follow. Sticking with the U.S., this chart and commentary from Robert Prechter's 2017 book, The Socioeconomic Theory of Finance, provide elaboration. The chart plots T-bill rates and the effective federal funds rate, a weighted average of the federal funds rate across all banking transactions from 1978 to 1984. T-bill rates peaked 4 times in 1980-1982. Each of those peaks occurred a month or more before subsequent and reactive peaks in the federal funds rate. The Fed's rate also lags at bottoms, as depicted on the chart at the lows of 1980, 1981, and 1982-83. The book adds that interest rates were in a relentless upward trend during the entire decade of the 1970s and that they have been stuck at zero since 2008. In both cases, despite the Federal Reserve's contrary desires, is powerful evidence reinforcing the point that the Fed is not in control of interest rates. The same principle holds in other nations, like Australia or the United Kingdom. Here's another chart and additional commentary from the Socioeconomic Theory of Finance. The chart plots interest rates on the UK's freely traded 3-month government bond against the Bank of England's official daily bank lending rate. These lines show that the Bank of England's rate-setting actions have lagged the freely traded debt market at all 12 major turning points in rates since 1993. The lags vary from 2 to 9 months, and the average lag is 4.8 months. The major takeaway is that central banks' interest rate decisions are not proactive, but reactive. Learn what markets themselves are suggesting is next for rates, as well as bond yields and bond prices, in the 50-plus virtual pages of our latest monthly Global Market Perspective. Just follow the link below this video.